If you'd invested just $1,000 in Apple 20 years ago, you'd have over $400,000 today. And it's not just Apple. Investing $1,000 in Amazon or Nvidia around the same time could have grown into hundreds of thousands as well. Yet many beginners think the stock market is just risky gambling. You see others making money, but it feels confusing, risky, or like it's only for the rich. Welcome to WealthWise Hub. I'm Fahad, a business consultant dedicated to helping freelancers, small business owners, and driven individuals unlock financial freedom and accelerate business growth. On this channel, we post weekly videos to help you save smarter, grow wealth, and take control of your financial future. You'll get proven strategies, step by step guides, and actionable investment insights tailored for real world success. In the next few minutes, you're going to get a roadmap that can truly change your approach to investing. You'll understand how the stock market works, how to start investing with almost any amount, even as little as $25, and how to avoid the common mistakes that can cost beginners money. Stick with me, and by the end, you'll be ready to take action and start building real wealth responsibly. We'll cover exactly what stocks are, how stock prices move, how to actually buy stocks, and the three mistakes that can hold beginners back. Plus, we'll compare stocks and crypto to see which is stronger, safer, and better for building long-term wealth. Follow along carefully, and by the end, you'll be ready to start investing confidently if you're serious about building real wealth. Hit subscribe now so you never miss one of our step-by-step guides. And don't forget to turn on notifications. We post new tips every week to help you grow your money smarter and faster. So, what exactly is the stock market? Simply put, it's a giant marketplace where people buy and sell pieces of companies called shares. Think of it like owning a tiny slice of a business. You're literally a part owner. Let's say you buy Apple stock. You now own a small piece of Apple. If Apple grows, releases new products, and earns profits, the value of your share goes up. Over time, this is how investors build real wealth. And the best part? You don't need to be rich or have special skills to start owning small pieces of companies. Why do companies sell stocks? Companies sell shares to raise money for growth, like funding new products, opening stores, or expanding operations, instead of just borrowing money from banks. Selling stock lets them grow faster while giving everyday people a chance to invest. Where does this happen? In the US, the main marketplaces are the NYSE and NASDAQ, but there are stock exchanges all around the world. Today, thanks to online brokers, you can buy shares from your phone or computer, often starting with just $1 or $25. Investing in companies isn't gambling. Your money is tied to businesses that produce real products and services, grow over time, and generate profits. Unlike betting on luck, you're putting your money into something tangible, and your wealth grows as the business succeeds. Comment the name of your favorite company below. I'll reply if it's beginner-friendly to invest in. Now that you know what the stock market is, let's dive into how stock prices actually move. At its core, it all comes down to one simple principle: supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. Sounds simple, right? But in reality, several factors influence these movements, and understanding them can make a huge difference for beginners. Here's an everyday example. Think about concert tickets. If everyone wants Taylor Swift tickets, but there aren't enough, the price skyrockets. The same thing happens in the stock market when a company announces a new product, beats earnings expectations, or gets media attention. Demand for its shares rises and prices increase. Other factors also affect stock prices. Company performance is a big one. If a company reports higher profits, launches a popular product, or announces an exciting partnership, more people want to buy its stock, which pushes the price up. On the flip side, losses, product delays, or bad news can make people sell, and the price drops. Economic conditions play a role too. Interest rates, inflation, and unemployment reports can influence how investors feel about the market overall. For example, rising interest rates make borrowing more expensive, which can slow business growth and make stocks less attractive. And then there's investor sentiment, the emotions and expectations of people in the market. Fear or excitement can cause stock prices to swing quickly, even if there's no new information about the company itself. That's why sometimes stocks move a lot based on headlines or rumors rather than real financial results. Most stock exchanges operate Monday to Friday, 9:30 a.m. to 4 p.m. But with online brokers, you can place orders anytime. They'll execute when the market opens. One important tip: don't obsess over daily price changes. Focus on the long-term trend and remember that small daily fluctuations are completely normal. Short-term swings rarely matter for long-term investors. Understanding how prices move helps you make smarter decisions. Instead of reacting emotionally, you can track trends, recognize opportunities, and avoid panic selling. That's how steady investors grow wealth over time. Pause for a second. What's one company you wish you'd invested in last year? Comment it below, and I'll reply with beginner-friendly tips on how to start investing in it today. Now that you understand stock prices, let's look at the types of investments you can make in the stock market. Choosing the right type matters because it determines risk, reward, and how hands-on you need to be. 1. Individual stocks. Buying shares of a specific company. Higher risk, but potentially higher reward. Example: if you buy Apple or Tesla stock and the company grows, your investment can multiply over time. But if the company struggles, your investment can drop in value. 2. Index fund ETFs. Think of these as a basket of hundreds of stocks. For example, the S&P 500 index fund holds the 500 biggest US companies. This gives you instant diversification, meaning your risk is spread out. Beginners often start here because it's safer than picking individual stocks. 3. Mutual funds. Professionally managed baskets of stocks. Easy for beginners, but often come with management fees. A fund manager decides which stocks to buy and sell on your behalf. 4. Bonds. When you buy a bond, you're lending money to a company or the government. Safer than stocks, but usually lower returns. Great for balance and stability in your portfolio. Most people start with index funds or ETFs. Warren Buffett even recommends them because they offer steady growth and low risk without needing to pick individual winners. Diversifying your investments spreads risk. You don't have to be a stock-picking genius to grow wealth. Investing consistently in diversified funds is the strategy most successful investors use. Comment index if you want my top 3 beginner-friendly funds to start with today. Now that you know what to invest in, let's talk about how to actually buy stocks. This is where beginners often feel stuck, but it's easier than you think. Step 1. Open a brokerage account. Think of a broker as your gateway to the stock market. Popular beginner-friendly brokers include Robinhood, Fidelity, E-Trade, adjust based on your region. Opening an account usually takes 10 minutes online. You just need your ID and bank information. Step 2. Fund your account. Many brokers have $0 minimums, so you can start with as little as $25. Decide how much you're comfortable investing initially and deposit it into your account. Step 3. Research stocks or funds. Use your broker's tools to explore companies, ETFs, or index funds. Look for long-term growth potential rather than short-term hype. Step 4. Place your order. Market order. Buys immediately at the current price. Limit order. Buys only if the stock reaches a price you set. Start small, even $25, $50 per month. Consistency is more important than timing. Dollar cost averaging. Investing a fixed amount regularly reduces risk and grows wealth steadily. Buying regularly, starting small, and focusing on long-term growth lets you take advantage of compounding returns. You don't need perfect timing to see results over years. Comment broker if you want my step-by-step guide for opening your first account and picking beginner-friendly stocks or funds. Before we wrap up, let's cover the 3 biggest mistakes beginners make in the stock market and how to avoid them. Avoiding these early can save you thousands and set you up for long-term success. Mistake 1. Timing the market. Many beginners try to buy low and sell high, but nobody can predict short-term movements consistently. Solution: invest regularly, even small amounts, using dollar cost averaging. Consistency beats timing every time. Mistake 2. Betting everything on one stock. Putting all your money into one company is risky. If that company crashes, your portfolio suffers. Solution: diversify. Spread your money across multiple stocks, ETFs, or index funds. This reduces risk and protects your growth. Mistake 3. Panic selling during downturns. Markets naturally go up and down. Selling in fear locks in losses and prevents you from benefiting when prices recover. Solution. Only invest money you don't need for 5+ years and focus on long-term growth, not daily fluctuations. Don't obsess over your account daily. Set alerts for important news, but avoid checking your balance multiple times a day. It leads to emotional decisions. Avoiding these mistakes keeps your investment safe, lets compounding work over time, and builds confidence as a beginner. Comment below which mistake you've been most guilty of. I'll reply with tips to correct it immediately. Before we go further, let's compare stocks and crypto, especially for long-term investing. Stocks represent ownership in real companies that produce products, provide services, and generate profits. Their value is tied to fundamentals like revenue, earnings, and growth potential. Companies like Apple, Amazon, and Nvidia have proven long-term growth over decades. Stocks are generally considered lower risk, long-term investments. Because they are tied to real businesses, your money grows steadily over time, though the returns are usually moderate. Crypto, on the other hand, is a digital asset. Its value comes mostly from supply, demand, and speculation, not from company profits. Prices can swing wildly based on hype or market sentiment. Crypto can offer very high returns, but it is extremely risky. In fact, studies show that over 90% of traders lose money, and crypto is even more volatile than the stock market. Here's the key principle. Low risk usually means lower returns, and high risk can give higher returns, but also higher chances to lose money. For example, stocks may grow 7 to 10% per year on average, while crypto could double or crash in weeks. So, which is better for the long term? For steady, long-term wealth building, stocks are the safer and more reliable choice. Crypto can be part of a diversified portfolio, but only if you understand the risks and never invest money you can't afford to lose. Risk strategies for stocks. Diversify across different companies and sectors. Don't put all your money in one stock. Invest for the long term. Ignore short-term market swings and focus on trends over years. Use dollar cost averaging. Invest a fixed amount regularly instead of all at once. Avoid trading based on hype or emotions. Focus on fundamentals. Comment below, are you more interested in stocks or crypto? I'll reply with safe, beginner-friendly tips to start building wealth with whichever option fits your goals. Alright, let's quickly recap what you've learned today. 1. The stock market is a marketplace where you can own pieces of real companies. 2. Stock prices move based on supply, demand, and investor behavior. 3. There are different investment types: stocks, ETFs, mutual funds, and bonds. Pick what fits your goals. 4. You can buy stocks easily through online brokers, even with just $25 a month. 5. Avoid the 3 biggest beginner mistakes: timing the market, putting all your money in one stock, and panic selling. 6. We also compared stocks and crypto. Stocks are generally safer, tied to real business fundamentals, and better for long-term wealth, while crypto can offer high returns but comes with very high risk. Start small, stay consistent, and think long-term. You don't need to be rich or an expert. Just take the first step today. Comment below with the first company or fund you plan to invest in, and I'll reply with tips to get started safely. If you want more step-by-step investing guides, beginner tips, and financial strategies, hit subscribe now. We post weekly videos that help you grow your wealth and take control of your financial future. Next week, we'll dive into understanding cryptocurrency, the technology behind it, the risks involved, and its potential for building wealth.